Good evening, and welcome to Truth Report. I'm Alex Truth. Tonight, we're following the money, and it's flowing out of America. The Federal Reserve, the institution that's supposed to be the bedrock of global financial stability, is facing a credibility crisis. And if you think that's just a Wall Street problem, think again.
I'm Maya Clarity, and tonight we're going deep on a story that connects Washington power plays to collapsing currencies in Jakarta, Sao Paulo, and Johannesburg. We're talking about how political interference with the Fed is creating a slow-motion financial earthquake beneath emerging markets, the economies that can least afford it.
Here's what we know. Political pressure on the Federal Reserve has been escalating in Washington for months. Calls to influence interest rate decisions, public attacks on Fed independence, and behind-the-scenes maneuvering that would have been unthinkable a decade ago. And the bond market is watching every single move.
And the bond market doesn't bluff, Alex. When investors start losing confidence in the independence of the world's most powerful central bank, they don't send letters of complaint. They sell. Quietly, methodically, and devastatingly. Tonight, we're going to show you exactly who pays the price when that selling starts.
So stay with us, because this story is about far more than interest rates and treasury yields. It's about power, credibility, and the invisible architecture that holds the global financial system together, an architecture that is now showing serious cracks. Let's get into it.
Let's start with what's happening in Washington. According to reporting from the South China Morning Post, the pressure campaign against the Federal Reserve has reached a level that leading financial figures are now calling self-destructive. Gregory Peters, co-chief investment officer of fixed income at PGIM, one of the largest asset managers in the world, managing over $1 trillion, used a very specific term. He called it an own goal.
And that phrase matters, Maya. An own goal. In soccer, that's when you score against your own team. Peters is saying that the political forces pressuring the Fed to cut rates are actually making it harder, not easier, to achieve lower borrowing costs. It's a paradox that Washington either doesn't understand or doesn't care about. When you undermine the credibility of the institution that sets monetary policy, investors demand higher risk premiums. That means higher interest rates, not lower ones.
Exactly right. And here's the mechanism. The Federal Reserve's power doesn't come from a printing press or a regulation. It comes from credibility, the belief among global investors that the Fed will make decisions based on economic data, not political pressure. When that belief erodes, investors start to question whether U.S. Treasury bonds are really the safest asset in the world. And once that question gets asked seriously, the repricing is brutal.
We're already seeing the early signs of what analysts are calling "sell America" trades. These aren't dramatic, headline-grabbing market crashes. They're quiet repositioning by institutional investors, sovereign wealth funds, pension funds, central banks, gradually reducing their exposure to U.S. dollar assets. It's the kind of movement that doesn't make the evening news until it's too late.
And this is where the story gets critical for people outside the United States. The U.S. dollar is the world's reserve currency. Roughly 60% of global foreign exchange reserves are held in dollars. When confidence in the Fed erodes, it doesn't just affect American borrowers. It sends shockwaves through every economy that's tied to the dollar, and that's essentially every economy on Earth, but especially emerging markets.
Let's talk about why emerging markets are uniquely vulnerable here. These are countries like Turkey, Brazil, South Africa, Indonesia, Argentina, nations that borrow heavily in U.S. dollars because their own currencies aren't stable enough to attract international capital. When the dollar strengthens because of uncertainty, or when U.S. Treasury yields rise because investors demand more compensation for political risk, these countries get hit with a double blow.
The double blow works like this. First, their dollar-denominated debts become more expensive to service. If you're the Indonesian government and you've issued bonds in U.S. dollars, a rising dollar means you need more rupiah to make those payments. That drains your foreign exchange reserves. Second, capital flows reverse. International investors pull money out of emerging market stocks and bonds and move it into dollar-safe havens, causing local currencies to depreciate further. It's a vicious cycle that can spiral into a full-blown financial crisis.
And this isn't theoretical. We've seen this movie before. In the 2013 taper tantrum, when the Fed merely hinted at reducing its bond purchases, emerging market currencies went into freefall. The Indian rupee lost nearly 20% of its value in months. The Turkish lira collapsed. South Africa's rand cratered. And that was just from a communication misstep, an unintentional signal from a Fed that was still operating independently.
Now imagine what happens when the signal isn't a miscommunication, but a genuine erosion of independence. When political figures openly pressure the Fed, they're telling the world that U.S. monetary policy might be driven by election cycles rather than economic fundamentals. For emerging market central bankers trying to maintain their own credibility, this is a nightmare scenario, because their monetary policy frameworks are often anchored to what the Fed does.
Let's dig into the specific transmission channels here, because this is where the real damage happens. The first channel is the dollar itself. The US dollar index has been volatile precisely because of these credibility concerns. When political pressure mounts and the market fears the Fed might cut rates prematurely, the dollar weakens, but that's not necessarily good for emerging markets, because the underlying cause is a loss of confidence, not a healthy policy adjustment.
Right, and that distinction is everything. A weaker dollar from a confident Fed easing policy in response to slowing growth? That's manageable. Emerging markets can handle that. But a weaker dollar from a compromised Fed cutting rates under political duress? That signals something much more dangerous, that the anchor of the global financial system is dragging. And when the anchor drags, every ship in the harbor is at risk.
The second channel is capital flows, and this is where Jim's Gregory Peters is sounding the alarm. According to the South China Morning Post's reporting, institutional investors are beginning to reassess their entire allocation to U.S. assets. Not just treasuries, but equities, corporate bonds, the full spectrum. When that reassessment happens, the capital has to go somewhere, but it rarely goes to emerging markets during periods of uncertainty. It goes to gold, to Swiss francs, to Japanese government bonds. The place is perceived as genuinely safe.
And here's the cruel irony. Emerging markets need capital inflows to fund their development. They need foreign investment to build infrastructure, to create jobs, to lift people out of poverty. When global capital retreats to safe havens because of a self-inflicted crisis in Washington, it's not American workers who suffer most. It's the factory worker in Vietnam, the farmer in Kenya, the small business owner in Colombia. These are the people who pay the highest price for political games they had no part in.
Let's talk about the debt dimension, because the numbers are staggering. According to the Institute of International Finance, emerging market debt has surged past $100 trillion. A significant portion of that is denominated in US dollars. When the cost of servicing that debt rises, whether because of higher US interest rates or a stronger dollar, governments face impossible choices. Do you cut healthcare spending? Do you reduce food subsidies? Do you let infrastructure crumble?
And those aren't hypothetical questions, Alex. We've seen those exact choices play out in countries like Sri Lanka, which defaulted on its foreign debt in 2022, or Ghana, which followed shortly after. Pakistan has been teetering on the edge. Egypt has been propped up by emergency funding from the Gulf states. These aren't isolated incidents, they're symptoms of a global system where emerging economies are structurally dependent on the stability of a U.S. financial architecture that is now being destabilized from within.
Now, let's ask the question we always ask on this show: who benefits from this? Because someone always benefits. When emerging market assets sell off, when currencies collapse, when governments are forced to privatize state assets at fire sale prices to meet debt obligations, somebody is buying. And more often than not, it's the same Wall Street firms and private equity funds that profit from the instability.
That's exactly right. There's a well-documented pattern in financial crises, what economist Naomi Klein called disaster capitalism. When a country's currency collapses and its government is desperate for dollars, international creditors and investment funds swoop in with conditions attached. Privatize your water utility. Open your markets to foreign ownership. Cut labor protections. The crisis becomes an opportunity to reshape entire economies in ways that benefit international capital at the expense of local populations.
And this is what makes the current situation so troubling. If the Fed's credibility continues to erode because of political pressure, we could see a wave of emerging market crises that creates enormous profit opportunities for the very financial institutions that are positioned to exploit them. The question is whether this is just an unintended consequence, or whether some actors actually welcome the instability.
Let's also examine what this means for the geopolitical landscape, because that's a dimension that doesn't get enough attention. When the US dollar's role as the global reserve currency comes into question, it creates openings for alternative financial architectures. China has been aggressively promoting the yuan for international trade settlements. The BRICS nations have been exploring alternative payment systems. These efforts have historically been dismissed as marginal, but every crack in the Fed's credibility makes those alternatives a little more viable.
And that brings us to a deeper structural question. The US has enjoyed what former French President Valéry Giscard d'Estaing called an exorbitant privilege, the ability to borrow in its own currency at low rates because the world trusts the dollar. That privilege has funded everything from military spending to consumer imports. If political interference with the Fed accelerates the erosion of that privilege, the consequences for the United States itself could be historic.
The South China Morning Post reporting highlights something that I think is crucial here. The Sell America trades aren't being driven by foreign adversaries or hostile governments. They're being driven by rational investors responding to observable political dynamics. These are pension funds with fiduciary obligations to their retirees. These are central banks with mandates to preserve the value of their reserves. They're not making political statements, they're making risk-adjusted investment decisions. And the fact that those decisions are now pointing away from U.S. assets should be a five-alarm fire in Washington.
Let's talk about the Federal Reserve itself and what options it has. The Fed is in an incredibly difficult position. If it cuts rates under political pressure, it confirms the market's worst fears about its independence and accelerates the credibility crisis. If it holds firm, it faces escalating political attacks that could lead to legislative challenges to its mandate. Either way, the uncertainty itself is doing damage.
And this is where the institutional design really matters. The Federal Reserve was deliberately structured to be insulated from short-term political pressure. The 14-year terms for Board of Governors members, the decentralized structure with regional Federal Reserve banks, the dual mandate of price stability and maximum employment, all of these features were designed to prevent exactly the kind of political capture we're seeing attempted now. When those guardrails are tested, the entire system is tested.
History gives us a cautionary tale here. In the 1970s, President Nixon pressured Fed Chairman Arthur Burns to keep interest rates low ahead of the 1972 election. Burns complied, and the result was a decade of stagflation, rising prices combined with economic stagnation, that devastated American workers and required the brutal interest rate hikes of the Volcker era to finally tame. The lesson was clear: political interference with monetary policy has catastrophic long-term consequences.
And the consequences were even worse for emerging markets during that period. The Volcker shock of the early 1980s, when interest rates were raised to nearly 20% to break inflation, triggered a wave of sovereign debt defaults across Latin America. Mexico, Brazil, Argentina, Chile, countries that had borrowed heavily in dollars during the cheap money era were suddenly unable to service their debts. The 1980s became a lost decade for Latin American development, with per capita income falling and poverty rates soaring.
So we've seen this pattern before. Political interference leads to misguided monetary policy, which leads to a correction that devastates emerging markets. The difference today is that the global financial system is far more interconnected, the debt levels are far higher, and the political pressure is far more brazen and public. The potential for contagion is exponentially greater.
Let's also consider the human dimension of this story, because it's easy to get lost in the abstractions of monetary policy and bond yields. When an emerging market currency collapses, food prices spike almost immediately, because these countries import much of their food and energy in dollars. Medicine becomes unaffordable. Families that were just barely making it are suddenly pushed below the poverty line. The human cost of a Fed credibility crisis isn't measured in basis points, it's measured in hunger, in preventable deaths, in shattered futures.
And that's what makes the casual attitude toward Fed independence so infuriating. The people making these calculations in Washington, whether they're doing it out of ignorance or cynicism, will never personally experience the consequences. They'll never skip a meal because the local currency lost 30% of its value overnight. They'll never watch a child go without medicine because imports became unaffordable. The costs are exported to the most vulnerable people in the most vulnerable countries.
Now, I want to be clear about something. We're not saying this crisis is inevitable. We're saying the conditions are being created for it, and the warning signs are flashing. The institutional investors beginning those Sell America trades are sophisticated actors who can see around corners. When they start repositioning, it's usually 12 to 18 months before the broader market catches on. We're in that early warning window right now.
And that's exactly why this reporting from the South China Morning Post is so important. This story is being covered more aggressively in Asian and international media than it is in the American press, and that should tell you something. The people who will be most affected by a Fed credibility crisis, emerging market economies across Asia, Africa, and Latin America, are paying much closer attention than the American public.
There's another angle here that deserves attention: the role of the US dollar in global commodity markets. Oil, natural gas, wheat, copper, soybeans, virtually all major commodities are priced and traded in dollars. When the dollar's stability comes into question, commodity price volatility increases, which disproportionately hits commodity importing emerging markets. A country like Egypt, which imports most of its wheat, can see bread prices spike violently because of currency movements driven by political noise in Washington.
And we should note that some of these emerging markets have been building defenses. Many Asian central banks, having learned from the 1997 financial crisis, have accumulated substantial foreign exchange reserves. Countries like South Korea, Thailand, and Indonesia are in much better shape than they were 30 years ago. But reserves only buy time, they don't solve the underlying problem if the global anchor currency is being compromised by domestic politics.
That's a critical distinction. Foreign exchange reserves are a buffer, not a solution. And using them to defend a currency is enormously costly. When the Bank of Japan intervened to support the yen, it spent tens of billions of dollars in a matter of days. Smaller emerging market central banks simply don't have that kind of firepower. They can slow the bleeding, but they can't stop it if the fundamental dynamics are moving against them.
So let's bring this together. We have political pressure on the Fed undermining its credibility. We have institutional investors beginning to quietly reduce exposure to U.S. assets. We have emerging markets sitting on record levels of dollar-denominated debt. We have commodity markets priced in a currency whose anchor institution is under siege. And we have a global financial system that is more interconnected and more leveraged than at any point in history. Every one of these factors amplifies the others.
And here's the synthesis that I think is the real story. This isn't just about monetary policy. It's about the architecture of global power. The US dollar's dominance has been the foundation of American geopolitical influence for 80 years, since Bretton Woods. It's what allows the United States to impose sanctions, to project financial power, to borrow at rates that would be impossible for any other country. When that foundation cracks, it's not just an economic event, it's a geopolitical restructuring.
And that restructuring is already underway. China's cross-border yuan settlement has been growing steadily. The BRICS nations have been developing alternative payment infrastructure. Central bank digital currencies are being piloted across Asia and Africa with interoperability features that could eventually bypass the dollar-based SWIFT system. None of these alternatives are ready to replace the dollar tomorrow, but every act of self-sabotage in Washington accelerates the timeline.
What we're witnessing is a slow-motion transformation of the global financial order, driven not by external competition but by internal self-harm. The Fed credibility crisis isn't being manufactured by China or Russia or any foreign adversary. It's being manufactured in Washington, by American political actors who either don't understand or don't care about the global consequences of their actions.
And let's be very direct about the accountability here. This isn't a bipartisan, Washington dysfunction story. There are specific political actors applying specific pressure to the Fed for specific short-term political gains. The financial media has documented this extensively. The question is whether American institutions, Congress, the courts, the media, will act to protect Fed independence before the damage becomes irreversible.
Because once credibility is lost, it's incredibly difficult to rebuild. Alan Greenspan spent decades building the Fed's reputation for independence. Paul Volcker endured enormous political hostility to establish the credibility that kept inflation anchored for a generation. That credibility is a public good, arguably the most valuable public good in the global financial system. And it's being treated like a political bargaining chip.
I want to leave our viewers with a framework for understanding why this matters to them personally, regardless of where they live. If you have a retirement account, a pension, savings in any currency, you are exposed to this risk. If the Fed's credibility erodes, it introduces volatility into every financial market on Earth. Your purchasing power, your retirement security, the value of your home, all of it is connected to the stability of the institution now under political siege.
And if you're watching from an emerging market country, from Lagos or Lima or Lahore, this story is even more urgent. Your government's ability to provide basic services, to maintain currency stability, to keep food affordable, all of that is connected to the credibility of a central bank in Washington that you have no vote in and no influence over. That's the fundamental inequity at the heart of the dollar-based global financial system, and it's being exposed right now.
So what can be done? First, institutional guardrails need to be strengthened, not weakened. Congressional leaders who understand the stakes need to reaffirm Fed independence publicly and legislatively. Second, emerging market countries need to accelerate their efforts to diversify away from dollar dependence, not as an anti-American gesture, but as prudent risk management. Third, international financial institutions like the IMF need to develop better crisis prevention mechanisms that can act before a full-blown emerging market meltdown, not after.
And fourth, and this is where we come in, the public needs to understand what's at stake. This story is complex and it's easy for eyes to glaze over when we talk about treasury yields and foreign exchange reserves. But the consequences are profoundly human. Every percentage point of currency depreciation in an emerging market translates to families making agonizing choices about food, medicine, and education. That's not an abstraction. That's someone's life.
Before we go tonight, I want to step back and identify the pattern we keep seeing on this show. week after week. Decisions made by powerful actors in wealthy countries, politicians, central bankers, corporate executives, create consequences that are overwhelmingly borne by people in less powerful countries with fewer resources to absorb the shock. The Fed credibility crisis is just the latest chapter in that ongoing story.
And the pattern has a name. It's called moral hazard at a global scale. The people creating the risk don't bear the consequences. The politician pressuring the Fed won't lose their home when the Turkish lira collapses. The hedge fund manager making Sell America trades will profit from the volatility. It's the schoolteacher in Nairobi and the shopkeeper in Manila who pay the price. Until that dynamic changes, these crises will keep happening.
That's our report for tonight. We covered the Fed credibility crisis and its devastating potential impact on emerging markets, the Sell America trades that are quietly reshaping global capital flows, the transmission channels through debt and currency markets, and the human cost that rarely makes the headlines but is always the most important part of the story.
If this reporting matters to you, share it. Talk about it. Hold your elected officials accountable for the consequences of their actions, all of their consequences, not just the ones that show up in domestic polling. The global financial system affects everyone, and everyone deserves to understand how it works and who it works for.
For Truth Report, I'm Alex Truth.
And I'm Maya Clarity. Stay informed, stay critical, and we'll see you next time.